Risk makes the investment world go round. Sometimes, as the world turns, we meet or exceed expected returns for a profit. Other times, the world and the wealth stops. I'm sure a lot of you think of AMC when I say that, but today I'm going to talk about the ABCs of risk and use some common analogies to break down this integral part of investing that will make or break your portfolio. Risk, the board game, immeasurably differs from the risk in the game played on Wall Street. On the other side of the golden coin, savoring incremental gains and wise navigation through volatile uncertainty remains the object of both games. Moreover, surviving the risk we're talking about requires a firm understanding of the investment game's tenets. Hasbro distributes definitive rulebooks, but Berkshire Hathaway, like all firms, doesn't. Regardless, several fundamental keys to understanding risk unlock higher possibilities of higher returns. Rule number 1 notes that the higher the risk, the greater the expected return. The word expected tops that phrase's importance hierarchy. Those omitting that word commit a deadly financial sin. The potentially hellish reality dictates that investing never guarantees expected returns, no matter how surefire the investment seems. When reality underperforms expectations, the financial loss hits harder than safer investments that yield lesser gains and losses. Events outside of the quarterback's control receive many linguistically liberated labels. Factors outside of an investor's control refer to systematic risk. Examples include the interest rate rising, workforce changes, and warfare. Portfolio diversity cannot mitigate systemic risk. However, unsystematic risk is mitigated by diversified portfolios. Diversification also maximizes returns. How is portfolio diversification achieved? One of the most common methods to achieve portfolio diversification is holding stocks in unrelated industries. Dispersing stock selection across numerous industries shields the chain effect that permeates across the sector when influential negative events occur in a juggernaut of the sector or the entire category itself. Like industries, mixing fund types contained in investment portfolios augments diversification. Investing in exchange-traded funds appeals to many diversification-seeking investors. ETFs enjoy the advantages of comparably less volatility than other funds and availability to buy and sell anytime during trading hours. Though people are free to trade, trading is not free. Paying a commission fee for each trade is the biggest drawback to ETF investing. Although this video highlights stocks, overloading portfolio composition with one type of investment or industrial category proves unwise. That said, converting those words into action via buying treasury bills carries zero risk, but inflation's relationship with returns renders profits negligible. The average inflation rate since 1950 is about 3.5%. The average return of T-bills over the same span is under 5%, according to Federal Reserve data. Complicated information translates to, don't put all your eggs in one basket. Whoever the investor is, Peter Cottontail or Peter Parker, everyone must develop a strong sense of basic risk measures. One of the chief indicators determining risk is beta. Beta is best defined as non-diversifiable risk of a stock with respect to the market portfolio. The risk of the market portfolio is always 1. As such, a beta above 1 indicates a risky stock, while stocks below 1 snuggle in safety. The lower the value under 1, the safer the stock is. Price-to-earnings ratios, otherwise known as PE ratios, measure expectations and market valuation risk, serving as an important risk indicator. High PE ratios typically allude to concerns regarding overvalued assets. Low PE ratios usually symbolize little valuation risk. Generally, the Dow Jones Industrial Average's mean PE ratio is 8 to 20% in times of economic stability. Noticeably, in recessions, there are wild volatility swings regarding PE ratios. Dividend yields, which are income from dividends as a percentage of what was paid for a stock, follow an identical path. Low dividend yields reflect a positive outlook for the company's growth prospects, while high dividend yields project pessimism. The classic phrase, buy fear, sell greed, derives from successful returns oftentimes occurring when investors buy stock during high dividend yield periods and sell at low dividend yield periods. Dividends produce over 40% of total return for stockholders. New investors absorbing this information will likely infer that personal investment risk is as much of a dice roll as the game risk. Like the board game, starting with a fundamentally sound understanding and expanding with educated impulsion conquers the challenge. Let me sum everything up quick with a guy much wiser and wealthier than I, Warren Buffett. Basically, knowledge is power, and wisdom makes the power even stronger. He said, risk comes from not knowing what you are doing, so wide diversification is only required when investors are ignorant. You only have to do a very few things in your life, so long as you don't do too many things wrong.